Recently on the channel here, we got a question on rebalancing. The question reads, looking back over the past 10 to 20 years, had I trimmed my 400% to 600% winners, I would have cut my gains, not increased them. I've stuck with sticking with my winners. If a company is doing well, you have to sit tight to get the bigger long-term rewards. Partially selling off any of these winners would have also generated tax bills. I think rebalancing should only be done to cull out poor performers. So this is a great question. When it comes to rebalancing, the first one is, you're right. Rebalancing for growth is not a great idea. When you're in accumulation mode, rebalancing, what it does is it takes the risk and it keeps the risk in your portfolio consistent. If you don't rebalance, your portfolio will, like the law of entropy, things move to disorder rather than order. So from order to disorder, your portfolio is going to move from the risk it's currently at to more risky over time in the market with no rebalancing. Now, it'll move more risky. It'll also generate greater growth over time with no rebalancing. So rebalancing is part of someone's plan in retirement because those people are looking for more predictability in their portfolio, not for maximum growth at that point. The mindset shifts when you go from accumulation to retirement mode. So I think there's a Charlie Munger quote that easier to make it than it is to keep it. And so that's why the retirement stage of life is so much more dynamic and challenging when it comes to portfolio management than accumulating over time. So first of all, you're right on this. If you sit tight, you get bigger long-term rewards. And that's absolutely true. In retirement, it's completely different, and we're not looking for that. Now, one of the ways that we can take advantage of the growth when you're rebalancing, there's a couple types of rebalancing. One is time-based, and every year on, say, January 1st, you go in and you rebalance your portfolio back to the original allocation that you started at. That's one way to do it. Again, if your portfolio has only grown a little bit, you're not capturing a ton of that growth. Where the alternative is trigger-based rebalancing. When your stocks have moved from, say, 50% to 60%, now you've captured quite a bit of growth before rebalancing, which is really just systematically selling high and buying low. So you sell those stocks and you add it to the fixed income portion of the portfolio and get back to your original allocation. Again, you're in withdrawal mode at this point in retirement. And so you're pulling from these funds, and that's where that cash management and rebalancing has a lot more, it's a lot more important on your portfolio at that time. I want to hit this next part. Partially selling off any of these winners would have also generated tax bills. Well, yes, if you choose to sell them. Selling's not the only option in a taxable account. Now, if these stocks or funds are in an IRA or Roth IRA, there's no tax bill for selling those inside of that account. But in a taxable brokerage account, like a trust account or a joint account, there is a tax bill for selling those. Now, there's other options in addition to selling. You can sell some gainers, while you could also sell some losers, and you could use your gains and losses to offset each other. If you practice tax loss harvesting over time, for example, March 2020, you could practice tax loss harvesting in March 2020 when stocks were down quite a bit, and you could then bank some losses that future gains could offset, that could offset future gains and eliminate a big capital gain bill potentially. The other is your gainers that are 400 or 600% winners. Those are amazing opportunities to do your charitable giving with. You can take those shares and give the shares away to either a donor advised fund or a 501c3 charity. And that eliminates the portion that you gave away. As long as you're giving the shares and not cash, you're not going to pay capital gains taxes. As long as they're long-term capital gains, you're likely not going to pay capital gains taxes on what you gave away. So there's more options than just selling something that has gone up over time. Giving away your highest gainers it's more money for charity. It's less tax for you. And it's getting rid of some of those gains in the portfolio. So these are some ways to look at rebalancing. So I hope this was helpful, and stick around for some more Q&A questions coming up soon.